So we now start with throughput accounting. What is throughput accounting? Now, throughput accounting is an approach to accounting which is largely in sympathy with the just-in-time philosophy. I told you earlier on that throughput works in a just-in-time environment. So the following are the main concepts in throughput accounting. Please, if you are solving questions, these are the concepts you put to heart. Okay, mostly in management accounting, we assume linearity of all costs at your level. As you go higher and higher, costs become like parabolas and hyperbolas and curves. But here, we try to keep it simple for you. So in the short run, most costs in the factory, with the exception of material costs, are mostly fixed. Okay, this is one principle you should keep in mind. So these fixed costs include what? Direct labor, and these fixed costs are called total factory costs. We can also call them conversion costs of what? Or what? Operating expenses. So that is the assumption we use in throughput. That one, we don't keep raw material stock, and in the short time, most costs are fixed and they are all incurred to convert raw material into finished or semi-finished goods. So under a just-in-time system, also we know we don't keep stock, and under throughput accounting, we assume material is the only variable cost. So if you are calculating contribution under throughput, material becomes the only variable cost. Please, I want you to keep this in mind. So in a just-in-time environment, the ideal inventory level is 0. We know that. We all know just in time, we don't keep stock. Now, products should not be made unless a customer has ordered them. That is one principle. And work in progress should be valued at material cost only until the output is eventually what? Sold. So that no value will be added and no profit earned until the sale takes place. That is why labor and other overheads are not considered at all. So profitability is determined by the rate at which sales are made. And in a just-in-time environment, this depends on how quickly the goods can be produced to satisfy the customer orders. So since the goal of a profit-oriented organization is to make money, inventory must be sold for that goal to be achieved. Okay, so that is about the basic concept about throughput. Now, what's the difference between throughput accounting and the normal accounting that we learned? Now, under conventional accounting, which is traditional costing, inventory is an asset. Okay. Under throughput, inventory is not an asset. It is a result of unsynchronized manufacturing, and it's a barrier to making what? Profit. So we see it as the cost we incur that is hindering the profit. So that cost must be incurred to convert a sale. Okay. Cost can be classified as either direct or indirect under conventional accounting. But such classifications are no longer what? Useful under throughput, because this mostly considers a modern manufacturing environment. So product profitability can also be determined by deducting a product cost from selling price. We know this, but here profitability is determined by the rate at which the money is earned. So the rate at which the money is earned is what we know as throughput. The rate at which money is earned or profit is generated is what we call throughput. Now, profit can be increased by reducing your cost element. Here, profit is a function of material cost, the total factory cost, and throughput. Is that okay? So these are the differences. If you are asked in the exam, you should be ready to explain. Now, marginal costing and throughput accounting both determine contribution by calculating the difference between sales revenue and variable cost. I told you earlier. But however, the contribution figure will be higher under throughput accounting since only material costs are recognized as being what? Variable costs. Now, under a marginal costing system, direct labor costs and certain overhead costs will be also deducted from sales revenue in order to calculate contribution. But under throughput, this is not so. They are all known as conversion costs, operating costs, or factory costs. It's the same. Now, throughput accounting regards such costs as fixed. And this is true insofar as they cannot be avoided in the immediate sense. Are you getting it? And they are all linked to convert material to what? Finished and semi-finished goods. Now, let's look at this simple illustration. How do we compute contribution under marginal costing? So under marginal costing, we all know that under marginal costing, we take sales minus what? Our variable cost. So we take 25 minus 5, not so, minus 3, minus variable production overhead, and that gives us what? Our contribution, not so, our contribution per unit, not so. So what do we get for our contribution per unit? So we have 25 minus 5 minus 3 minus 2. And that gives us what? 15. So our contribution per unit is 15. And then when it comes to product Y, we have 30 minus 8 minus 6 minus 2. And that gives us 30 minus 8 minus 6 minus 2. That gives us 14. So if we want to calculate contribution under marginal costing, our total contribution becomes how much? Total contribution. We know this is going to give us what? 15 by, we are producing 10,000 units for product X, not so. And that gives us how much? Put here product X. That gives us 150,000. And we are producing 14. We are making 14 for product Y. That's 14,000, 14 times, sorry, 15,000 units. And that's going to give us 210,000. Not so? 210,000. So our total contribution and the marginal costing becomes 150,000 plus 210,000. And that's 360,000 for marginal costing. What about under a throughput scenario? So in a throughput scenario, our contribution becomes a throughput. We know that that contribution is what we call throughput, okay? So you can call that contribution throughput return or just throughput. The rate at which what you make the sale, right? Or generate the sale is throughput, which we call throughput return. And to generate the sale, you must convert this raw material. You get it? So you can either call it throughput return or throughput contribution or just throughput. All are allowed, but just get the notion or the understanding behind it. So yeah, we just take this. You realize that the throughput, your contribution is going to be higher. 30 minus 8, that gives you 22. Okay, so this is it. So the same way, you just multiply by this and just multiply by that to get your total contribution and that throughput. So this is the basic calculation of what contribution and the throughput accounting. Now, let's understand one particular thing, which is throughput accounting and the theory of constraints. Now, throughput accounting is based on the theory of what? Constraints. Now, a constraint is a factor that sets a limit on the amount of throughput that is possible. There are some factors of production that can limit you in achieving the throughput you desire, right? Or the money you want to earn. These are limiting factors that could be, in theory, be your sales demand or the organization for the organization's output. So mostly you may have sales demand or other binding constraints. Okay, so the objectives of the theory of constraints, what does it want to achieve? So this is aimed at maximizing your total throughput given the existence of a bottleneck. Why do we say bottleneck? Now, the limiting factor, or what we call the constraint, is treated as a bottleneck. If you have a bottle, right? If you have a bottle and then you are pouring water from the bottle, you get it. So let me just bring a big pan here. Now you realize that if the water is flowing, it flows freely from this part, right? It flows freely, but when it gets to the mouth of the bottle, there's pressure. Not so. It comes slowly. Not so. That is why we call them bottleneck resource, right? The reason why we are saying bottleneck resource is that it slows down the production process. Okay, bottleneck resource because it slows down the production process. So if you are pouring the water, you realize that here it comes quickly, but when it gets to the mouth of the bottle, it comes very slowly because of the pressure. All this wants to go. Now, why is this important? Let me give you some scenarios, then you understand what we mean under the theory of constraints. So let's say in a fashion, let's say you have a fashion company, not so, which has 3 processes, okay? And these processes are what? Cutting. So we have the department that cuts the materials. We have cutting, we have finishing, and we have packaging, not so. Now let's see something. If the cutting department can cut 1,000 materials, not so. Finishing department can only finish 500 materials at a time. And then the packaging department can only package 200 materials. Which one is the bottleneck resource? It means that this packaging department becomes the because that's the final output, right? That's the final department that works, or that's the final process. Now, if he can only package 200 materials at a time, then this 500, if it is sent, only 200 can be packaged. Therefore, you cannot do 500. You can only do 200 because remember, it's a just-in-time environment, right? So we don't keep stock. That is what I'm telling you. We don't keep stock. So because it's a just-in-time environment, we can only, you see, though this guy has the capacity to what? Finish 500 materials, we can't do 500 again because this process or this department can only produce 200. So we will therefore what? Only stick to what? The 200. Is that okay? So that only 200 can come here. Since this guy cannot do 500, then only 500 could have come here. But he's also limited by 200. That means this guy should only what? Do 200. So that 200 goes here and another 200 goes here so that it meets the demand exactly to generate your throughput. You get the whole idea. So that is it. Okay, so that is it. Understood. So this is the theory of constraints. So this guy is slowing the whole process down. Okay, let's take another simple scenario. Let's come to a hospital. Now, in the hospital scenario, let's say if you go to the hospital, we have the outpatients department, that's the OPD. Now, from the OPD, we move to, let's say, the doctor. Also, you go for your card, you move to the doctor. Then let's assume everybody that comes to the hospital goes to the ward, right? Now, under the OPD, let's say the OPD can hold 100 patients, not so. The doctor can only see 30 patients at a time, not so. And then the ward can only take 10 people. Which one is the production process? Which one is the bottleneck resource? Which one is at the mouth of the bottle, slowing down the whole process? Is the ward. Because if the ward can only take what? Assuming nobody goes home, we meet exact demand. If the ward can only take 10 patients, then that means the doctor can only look after 10 patients and the OPD can only take 10 patients because I'm assuming everybody goes through this process. Okay, if that is the case, then because of just in time, we cannot look at 100 patients again. We have to do 10 because we are in a just-in-time environment, right? That is why just-in-time is important for the concept of throughput. Now, the same way, if you have machines, machine 1, machine 2, machine 3 in a different organization also, now they all must go through, the product must go through all these 3 machine types before the final product comes out. Now, machine 1 uses 2 hours to produce, machine 2 uses 1 hour to produce, right? And machine 3 alone uses 9 hours. Which one is slowing down the process? It's machine 3 because it takes a longer time to produce, meaning that this one will finish and this one will still be wasting time. So it's the bottleneck resource. So most of the time in your exam, bottleneck resources might be material kgs, just like we looked at in limiting factor, and then it may be also hours. Mostly it is hours, labor hours or machine hours, which you get it as what? Machine utilization. We know machine utilization is how many hours the machine consumes. So in your exam, be careful. Instead of seeing machine hours, they'll tell you to look for machine utilization, which is how many hours you require for production, right? Remember yesterday or in our previous session, we looked at what? Requirement for production, how much is required for production against how much is available. And also, that is your machine utilization. Is that okay? So this is the theory of constraints. I hope by now you've understood. Now, there may be different constraints in a question. The same system for limiting factor is used. I get it. So, production binding constraints, we can have productive time available on a machine, sales or demand for the firm's product. We can have what? Unattractive selling price due to competition, delivery on time to a particular customer, lack of product quality and reliability, lack of material supply. All these may be what? Constraints. Now, let's look at the throughput accounting concept. Okay. So the first concept is that in the short run, all costs in the factory, with the exception of material, are fixed costs. We looked at this earlier on, and these fixed costs include direct labor costs. Are you getting it? So the summation of these fixed costs are known as total factory costs. That is labor, variable overheads, fixed costs, or fixed overheads. They are all known as fixed costs. Then the second concept is that in a just-in-time environment, holding excessive inventory is a bad thing. And an ideal inventory level is always zero. Products can only be made when there's an order for them. To increase work in progress and finished goods stocks creates no profit. We saw these concepts earlier on, but now I'm breaking them into three major concepts for you. Now, the third concept is that profitability is determined by the rate at which money flows to the organization by the amount of sales made, which we call throughput. This depends on how quickly goods are produced to satisfy customer order. So that is why you realize that when we're looking at some of these bottlenecks, if they slow down the process, you can't get it. That's why we call it throughput. I get it. It goes through the process quickly and generates a profit. So producing for stock does not create what? Profit. So improving the throughput of bottleneck operations will increase the rate at which customers' demand can be met, and that can improve what? Profitability. Okay, that's the concept of throughput. Now, people just focus on what? Calculation, but these concepts are important as what? They can ask you. So the theory of constraints is applied within an organization by following the following 5 steps. They can ask you the 5 steps in a throughput accounting scenario. So a tool which was developed to help organizations deal with constraints. So what do? You mostly identify the system's bottlenecks. Bottleneck is the same as what? The limiting factor. And now you have to decide how to exploit the system's what? Bottlenecks. So this involves making sure that the bottleneck resource is actively being used as much as possible and is producing as many units as possible. Okay. The next thing you need to do is to subordinate everything else to the decisions that you made above. So the production capacity of the bottleneck resource should determine the production schedule for the organization as a whole. So idle time is mostly unavoidable and needs to be accepted if the theory of constraints is to be successfully applied. By all means, some machines may break down. I get it. Even though in a just-in-time environment, some machines may break down. We may have times where workers may not be working. All these things, you must inculcate them into the system. So after that, you have to elevate the system's bottlenecks. This will normally require capital expenditure, spending, buying capital items, okay, to elevate the system's bottleneck so that you do not face so much bottleneck. Now, if a new constraint is broken in step 4, you have to start again, okay? So this is the likely constraint in the system is likely to be the demand. Demand can change at any time, okay? So in decision-making scenario, when it comes to throughput accounting, are you getting it? So throughput accounting can be used for performance management and decision-making. So decision-making is just like the limiting factor decision. So I'll teach you all the 2 ways and how to use the throughput accounting ratio to measure performance of products or divisions. It can be used, okay, depending on how the products are performing. So applying throughput accounting to a multi-product decision-making problem, what you have to do is the same steps: identify the bottleneck or the limiting factor, calculate your throughput return per unit for each product. That is your contribution, your throughput contribution. Then you calculate your throughput per bottleneck resource, which is like your contribution per limiting factor. Rank them in order of priority, not so in which they should be produced, starting with the product that generates the highest return per bottleneck first. Are you getting it? Then the next is compute the optimal production plan, allocating the bottleneck resource to each one in order, being sure not to extend the maximum demand, exceed the maximum demand for any of the products. Then finally, you calculate the maximum possible profits. Okay. So that is it. Now, when we are looking at performance measurement using throughput accounting, okay? Now, performance measurement in throughput accounting is based on the concept that the aim is to maximize your throughput, which is your throughput contribution. This is achieved by maximizing the throughput per unit of your bottleneck resource, right? So we can make profit, all right, but maybe the hours available is many. We want to see how much profit or how much throughput we can make for 1 hour. How can we maximize that despite the production constraints? That is what we are talking about. So many organizations have multiple product lines, okay? So total throughput is maximized by giving priority to those products that can earn the largest throughput per unit of bottleneck resource, just like limiting factor. So products should be ranked in order of priority of throughput per unit of your bottleneck resource. Okay, so throughput accounting or the throughput per bottleneck resource is your sales minus your direct material cost all over the bottleneck resource. So this one is like what? Limiting factor, the contribution per limiting factor, okay? So you are saying that, okay, how do you get, you first need to get your throughput contribution or your throughput, and also when you finish, you divide by what? The amount of what? Amount of limiting factor, not so. That is what we know. So it's the same as what we call the throughput return per bottleneck resource. If this is maximized, then we know that what? Your throughput will be maximized. So take a careful look at it. So one important concept that a lot of people always fail to use in the exam is the throughput accounting ratio. This will be used to measure the performance of products. Now, this is a ratio of the throughput per unit of your bottleneck resource to the factory cost per unit, or your operating expenses per unit, or your conversion cost per unit. They are the same. Factory cost, conversion cost, operating cost, they are the same, of your bottleneck resource. Now, this ratio should be as high as possible and should be more than 1. Okay, so once it's more than 1, you remember what we call degree of operating leverage under cost volume profit analysis. It tells you how much fixed costs are your business, and therefore how much profitable or your contribution, how much profit your contribution can generate, okay, after covering fixed costs. Now, throughput accounting ratio is a useful tool for performance evaluation, which you need to learn for your examination. I told you earlier. So how do we calculate this throughput accounting ratio? Okay, so your throughput accounting ratio is your throughput return per unit of your bottleneck resource over your factory cost per unit of your bottleneck resource. So how do we calculate factory cost per unit of your bottleneck resource? This is your total factory cost over your total unit of bottleneck available, okay? So note again that total factory costs are also described as total operating costs, or total operating expenses, or total conversion costs. They are all costs other than material costs and are regarded as fixed per the period. So let's look at how to calculate the throughput accounting ratio, taking a simple example. Is that okay? So we'll come and look at decision-making time, but let's look at a simple question. So it says that assuming a company manufactures a single product, okay, each unit of the product takes 2 hours to make on machine X, and output capacity is restricted by available time on machine X. So you can see that the restriction or the bottleneck resource is what? The available time on machine X, which is machine X hours. And now it's only 2 hours that we use to make a product, right? That's per unit. Now, which is restricted to 500 hours per week. So that means in every week, we have 500 hours available. That's the limitation. So the product has a material cost of 20 cedis per unit and sales for 160 cedis per unit. And we've also been giving total operating cost per week. Now look at something here. We need our throughput accounting ratio. Not so. We need our throughput accounting ratio. And how do we calculate throughput accounting ratio? Now we know our throughput accounting ratio, which people call T-PAR, is giving us what? Your throughput per bottleneck, also throughput per bottleneck, which is like your contribution per limiting factor all over what? Your total factory cost. Also, you all know factory cost or total operating expenses per bottleneck, right? Now, how do you get this then? What is a throughput accounting ratio? First of all, we need our throughput, okay, per bottleneck. Throughput per bottleneck is the throughput you get for each hour, okay, which is giving us what? Your throughput contribution, or your throughput, I get in it, contribution, let's call it throughput contribution because you are used to contribution, over your bottleneck hour. That's all. Now we know that the throughput contribution is actually what? They said the sale is how much? It's 160 cedis, not so. That's your contribution. 160 cedis, and material cost is what? 20 cedis per unit. That gives us 140 cedis per unit. This is our throughput return. Now, if we want our throughput per bottleneck, we know that this 140 cedis is per unit, right? And then it takes what, 2 hours to produce per unit, 2 hours per unit. So that means we get what, 70 cedis per hour as our factory cost, as our throughput return per bottleneck. So this is 70 cedis per hour. Now we need the second part, which is the total factory cost per bottleneck. Now we know total factory cost is how much? Total factory cost is actually 30,000 cedis per week. And available hours per week, you see everything I'm grouping like terms. The other one was per unit, this is per week. So we also divide by 500 hours per week. And also per week will cancel itself off. So that means we have 30,000 divided by 500, 30,000 divided by 500. That gives us 60, that's 60 cedis per hour. Not so. So we know that we have 70 cedis per hour to 60 cedis per hour. So what then becomes our throughput accounting ratio? That's the A over B. So our throughput accounting ratio becomes what? Your 70 cedis throughput per hour over your what? Your factory cost per hour, right? 70 per hour over 60 per hour. Because they are all per hour, it cancels off and gives us a ratio of how much? 70 divided by 60. And that gives us what? 1.167. Not so? And that tells us that what? Since the T power or throughput accounting ratio is greater than 1, the product, I said the profitable. The product is profitable, right? Why is it profitable? Because it can generate an excess of what? 16.7% of its factory cost as profit. Okay, so if you want to calculate profit under this one, I get in it, which is the throughput, the total throughput minus your fixed cost or your factory cost. Okay, so that is how you calculate the throughput accounting ratio.